Hey everyone, my name's Andy. I'm from Finding Value Finance. I'll be your host today. I've got Patrick with us. We're going to talk charts, talk about what's going on in the markets, give some updates. So thanks, Pat. Thanks for coming on. Really appreciate it.
It's always fun to catch up. Sometimes it's always good to put some words behind the charts because sometimes I put out I have an idea, I put out a chart, and then I just write some type of clickbait title. It's short, it's cryptic, and then I see in the comments, okay, nobody understood, or they partly understood, or they used my chart to fit some type of bias they had, but it wasn't quite the message I was trying to like. But you know how it is. You have like a paying members website, so like the detailed stuff, of course, for the members on Twitter. But I don't like it's good. I think these verbal in the comments I read on YouTube, there people really appreciate the words we put behind these charts. And look, yeah, let's help people out there. It's all good.
So if you want to follow you, it's at Bad Charts One in Twitter, I
Uh,
think, because that's what you're referring to. All the charts that you create. He has a ton of good charts. I always check out your channel and look at the big picture view stuff that you guys post. So looking at the big picture view, I know that you posted something on the producer price index
yes.
versus the S&P 500, NASDAQ or S&P 500. I can't remember which one it was.
I put a S&P because S&P, I have a data feed that goes all the way to the early 1900s. Yeah, and that's why I ordered Dow Jones. NASDAQ, it's cool, but you know, when you don't have you don't see that 1970 cycles, you don't see that 1920 cycle or 30 cycle. You're kind of missing a part of the big picture, right? But look, the NASDAQ or SPX, I could overlay them over, you know, yes, maybe the NASDAQ might go more bonkers, but they track the same capital flows. So I think the idea is, am I in a secular bull market for commodities, or am I in a secular bull market for growth? Because that's, from all the charts we've looked at or I've looked at, that's primarily the two major assets that we can actively play. I know some people can say, okay, well, you could play bonds, yields. Okay, fine. But though the most popular one is just stocks, right? Anybody has a broker could buy like regular stocks. Anybody has a broker, they could buy gold miners, whatever. So those are the two primarily that fight against one another. And it's critical to understand where the capital flows are going, because what the recipe that's been working since 2009 to all the way to 220, 222, 221, it's that recipe might not work anymore from 224, 223 all the way to 230, you know, like 2030. And if people always try to, you know, buy the dips in Tesla, buy the dips in Nvidia, and then they're not getting the same returns on those buying the dips, they have to wonder why don't have the same performance. Well, using ratio charts, they could see that. Well, look, I have to show you this chart there. Nvidia versus the gas producers, the oil producers, you know, it's like, and even if both of them go up, why go up Nvidia if the oil and gas plays are outperforming Nvidia? People have a hard time wrapping their head around that. Oh, my Nvidia went up 100%. Yeah, but the oil and gas, I'm not talking about penny stocks going hundreds of percent. I'm talking about the ETF. It went up 200%. So why are you long Nvidia when you could be? And these oil plays, they have crazy dividends. I think Nvidia must be zero dividends. I've noticed that tech stocks have very, very, very low dividend. Maybe Apple has 0.5%. It's look, I don't know much about that business model, but if you're in a secular bull for oil, gas, they're going up, the share price is outperforming the tech stocks, plus they're giving you dividends. It's like it's a no-brainer.
Yeah. So what kind of environment are we in then?
All
I
right.
mean,
I'll share a screen then. It's time. Oh, all right. Okay, I have to find, I could redraw it maybe. I had my, okay, I'll do, so primarily you want to know SPX, how's it performing versus PPI or CPI, or we could do it energy. Here is reset chart view,
this is the one
max
I
screen.
like.
Ah, goodness. Guys, look, we have data going all the way back to, Yeah, here's, I'll put a line chart here. I'll remove the 12-month moving average. I'll keep the 3-year. I'll keep the cloud. Look, guys, we have data going back since 1913. And you got to respect this because look here, a clear breakdown, rising trend line, multiple points. And that was the blow off top for US equities priced in producer price, inflation, energy. I'll show you guys with the oil chart. It's almost the same. Then it hibernates. So for all this period, it's just violent rallies up. It's going nowhere versus PPI. But you got to notice during this period, that's when oil went up. Gold, if it wasn't pegged, it would have went up. I think they even had to unpeg it and raise it a little bit because there's so much pressure during that time. Silver's went up. And after that, once SPX is able to break out versus PPI, that's it. Just go long growth stocks, and then you have the Nifty 50, the Nifty 50 and all the 60s, the go-go 60s, all that beautiful IBM, Xerox, all that stuff there. Whatever, I'm pretty sure our parents or our grandparents, they must have heard the same type of FOMO-driven headline news back in those days, right? I know IBM could go no wrong. You know, I don't know what tech stocks they had back then, the equivalent, but I'm sure there's a whole bunch. Until the cycle just repeats, it slows down here. So here's a huge trend line break. Yes, US equities did a blow off top versus PPI here, higher high, but the momentum was starting to show weakness. And these trend lines, these rising trend lines, this is important, the angle. So if I have something super steep and I break to the downside, often there's still energy up, a possibility of a violent rally up. But that trend, this less and less steep it is. Once it breaks down, there's less and less upwards momentum. So that's why when we talked before the show there that not all breakout lines are made equal. A breakout line, I'll put it here. I'll put, where's it hidden? I'll put my angled thick. So here's a 49-degree angle. The less and less steep it is, this is what I call a final breakout line, a horizontal breakout line. That means the momentum is neutral and it's negative. Well, if it breaks down, it's negative even more because it already has the momentum from a high up here and then it goes down. So once you're below a neutral, a flat plane, and the price goes down below it from above, the momentum's already downwards, right? Because you were higher and now you have to go down to break that. So that's practically death sentence. Once you get those type of tops here, that's it's game over. Here in the night, and after this, see this less slanted line, 1, 2, 3 valid breakdowns, small retest, dump, try to go back above, but that upwards momentum that I had before, it's just not there yet until you get another angle black thick, until you get another breakout line. And you could probably have been more aggressive here. Maybe here, somebody could have played it here, beautiful bottom. But this is the bull era of the ages for growth stocks, right? This is a Berkshire Hathaway, Pepsi, all this stuff. They're just Microsoft. This was just bonkers, until another 1, 2, 3, 4-point breakdown below 3 moving average, below the cloud. It's a blow off top.com bubble. Like, even had here some less, some tops carving out with less and less steep angles, breaks down, can get back above. So what happens is, we all know what happened from 2000 all the way to 2008. That was oil, uranium bonkers, and gold and silver. Gold, silver, even they profited on the final recovery phase of the US stocks versus PPI. Gold and silver still like that until they get overwhelmed. Once the SPX breaks out versus PPI, that's the death knell. And you see, look, 2013, guys, that's the breakdown in the gold chart. That's breakdown silver chart. That was okay. That was a big signal, actually. Yeah, gold and silver creating huge tops. You could have had wishful thinking back in 2013. They might go back up, might be shallow. But if somebody would have been looking at the SPX versus PPI, they would have seen, oh my goodness, this is it's done. It was done. So now, beautiful bull run for SPX versus PPI. Look, depends how, there's a few ways. So there's a trend line here. There's another one here. 1, 2, breakdown below 3 moving average, violent rally up. The cloud holding it, but we're still not above we're still not above. There's a wall right here. Let me get, that's too thick. It's too thick. Get style. There's still a wall here, previous support and resistance, still not quite above, but a lot of damage is done. We could be, sometimes I've seen the analog, if we're kind of maybe here, 1968, 69, that we're completing this type of move here, where the US equities are really trying right here, there. We're probably in this type of zone there, where this last final line of defense. And as soon as that falls, as soon as this, probably this thick line here, if ever that falls, the damage is, we're going to go like this, our 10-year, this was 15-year, what is that? 2016, yeah, 69,
69 to 80 something.
yeah, 80, 84, like, well, this is the way to do it, guys. Then you draw a line here, wherever this rally fails. If that was the end, then this is going to be the next wake-up line for US equities versus energy, all that. I'll just do a, where's my pattern line? This one. Patrick has to be here. Oh, here, path line. So then after that, we just have to wait. We don't know how low it's going to go. It doesn't quite matter. It doesn't really matter what happens to this chart. As long as it stays contained, it has downwards momentum, that means it's not going to be outperforming uranium, copper, platinum, like all that stuff there. It just, you have, no matter how steep this is, people look for end of the world, catastrophe, huge violent. People love, like, you know, the doom stuff there, the doom mongerers, they love that fear porn, all that. Look, it doesn't quite matter. As long as you're below a descending trend line, you're in a bear market. As long, no new highs, lower lows or higher lows, but as long as it stays contained here, US equities are just muddling around. They're just stagnating. So that means the capital flows aren't feeding the US equities like they used to have a bull run. They're going somewhere else. So that's why we're going to look at oil. We're going to look at all the other instruments that we could actually put our money in, you know, because I don't think anybody could buy the PPI. Like, I don't know, even that's just
Index.
a data feed, right? But you could actually play companies that you're allowed to put in your 401k plan. You could buy companies that have dividends. You could buy a whole bunch of stuff. There's a whole bunch of stuff you could buy, but once you understand where you are in here, and look, I would get scared if ever the US equities are able to go above flat line here. I would say, okay, whew, okay, it's still, I would have to look at the individual charts of the oil plays, gold, silver, to really see where I am. But I would definitely understand that if US equities are outperforming PPI, that all the commodity plays do not have the tailwinds. They still have headwinds. You know, it's still muddling around. We're not quite in a full bull era yet. If ever the price climbs back above here, I'll do a scenario here, and it does something like the 1970s. So you got to be really, really careful. But there's a lot of damage after a huge drop like that. It'd be hard, you know. It's gonna need some type of 1969 type of miracle. But there's so much more evidence, Andy. The yields, you know, breaking out of 40-year downtrend, just other clues that has my bias bearish on that chart, even if it hasn't fully broken down yet. My bias is still bearish because of everything else I'm seeing with the other instruments.
We like you got 1967 highlighted. Are we more like 67 or more like 71 or 2? I'm just looking at the pattern that's creating, almost like a head and shoulders pattern.
Yes. So if I remove the,
you
know what I'll do? I'll do this.
You're gonna copy the.
Yes, I'll split the screen. So here is my.
You see how it's like got a head, almost like a head and shoulders, and it looks like almost like a head and shoulders on the right, and almost like 72 it could be. I don't know, but obviously no one knows with 100% certainty. So the way that I looked at it is that if you draw a neckline going across, if you had put a hypothetical neckline, then you'd have a right at the bottom of the, like okay, I see what you're doing there. Yeah, like that. Yep. That's, you can do it like that.
Yeah. Okay. So here's like your left shoulder, your head, your right shoulder higher
Yes.
up.
Yep.
Yeah.
Yep. Yep. And the stimulus money drove the right shoulder a little bit higher in today's thing, and the Kiwi that they brought down
Yeah.
interest rates with. Yeah, yeah. I think it could be like that. I don't know.
Well, in all
Yeah.
cases, this is what's happening there. So it could be a
Mhm.
massive top formation, like bigger than what we imagined. That's still playing out there. So yeah, we could be, yeah, 70. Yeah. And I have other charts also that it looks like we're exactly at 1970. It's like, so often we like having dates. People like that. Oh, Patrick, we're in the 1970s. Well, yes, there's a fractal. It's rolling over. It's rolling over a little bit like the late 60s, early 70s. It's not quite rolling over like the 2000s, but financially wise, like there's a lot of analogs also close to the 2000s, but I like the 70s because of that yields, or late 60s, the yields breaking out and going upwards is so similar. And I know that drives a lot. The capital is driven a lot by that destruction of purchasing power. But that could be a huge topping pattern. Here, see, was so violent here, the dot-com bubble. So violent. It went up so high, it distorted kind of the chart. Instead of it having a nice rollover, it just rocketed to the moon, and then it just plummeted. Yeah, this could be something like that there. But it's
Yeah.
definitely starting to, the longer the price starts trending below, this is a 3-year moving average. That means you're giving an opportunity for the moving average to halt or go down, right? So moving average is just takes the data points everywhere and just, adds them up, divides by the number of samples. So if the price is always above, then the moving average will be inclining because you keep adding data points above. As soon as you start seeing weakness here, well, here's the first sign of weakness. Okay, it went up. Here's another sign of weakness. But the longer, maybe that's not the best tool. The longer periods of time you stay below the moving average, now you're getting that pressure. You're getting that downwards pressure. So this is the first. We've been below the 3-year moving average for a while now, and we barely went above, and now we're below. We're trying to go back above. So look at the moving average now; it's flat. So when you have an important moving average that starts to stay flat, that means the momentum. You're giving an opportunity for the market to decide. Oh, man, maybe I want to go in a secular bear market now because the moving average is rolling over. So this is what's created right now. We're creating an opportunity for this thing to structurally actually break down and enter a bear market.
Mm-hmm.
Yeah, that's pretty big picture. We're kind of still feels early when I see that.
It is early. It is early.
Because
Definitely.
when it's going to be the end? It's going to be the end when I flip this chart and we're down here somewhere. That's when the end happens. It's when this is down here somewhere. I don't know where it's going to be, but it's when this crosses it's like this is the end there. We haven't started, practically haven't started there. This is how the end is, right? And then the price starts staying above the moving average starts coiling upwards, and then you have a secular growth stock bull era.
Yeah.
Just like we had here there on the way up. So it's just bonkers there. It's just so, I don't know, people maybe they're hoping for a 1929 crash where it's super violent, but I have a feeling it's going to be more like, well, yeah, the 70s, the 2000s.
I think it'd be like the 2000s. That's my guess.
Yeah, because there's
Yeah.
a lot. When I try to rationalize this, but everything's more like financialized, the whatever the fail safes. It might be more, it might not even go this crazy downwards. They might save it, it might just muddle sideways in a tighter range for 5, 6, 7 years. It's like,
Is they print money.
yeah, exactly. But that's just going to fuel the faster they are to print the money, the faster they're going to fuel the destruction of purchasing power, and the more gold and silver and oil and all that, the real stuff that's going to have to be priced in, right? So are they going to be that slow like the 70s? Yeah, maybe it's going to be even faster. Like sometimes, I even wondered that. I was wondering if this fractal here, yeah, that we're back in 2007, but not quite. because this is the chart. This is the chart. It's gold versus SPX, and I was trying to look at it today. And it's finally, it's finally giving some signs of life. Look at that thing. So it's finally starting to try to turn up again. And even the gold, even silver, here's a line. This is probably the line to keep your eye out for. Yeah, dot 47, but it's more like it's a zone. So anything here, dot 50. Look, man, when gold from 2019 all the way here to 2020, gold went up from what? From 1,300 to 2,000. There went $800 just in that move up. So imagine an $800 move in gold. Let's say from here to here, and it does 800. Even to get to that line, when it gets, what's the SPX at today? SPX is at, it's at 4,300. Let's say SPX is at 4,000 when we get at the half. That means by the time we get to this neckline, SPX could be at 4,000. Gold will, if the ratio is 0.5, that means gold has to be 2,000. So SPX at 4,000, gold's at 2,000, even before it breaks out. And then as that ratio goes up, then add another $800 on top. That's probably going to be where people are going to start piling on the gold train. That's probably where we're going to have to start taking profits, because that's going to be a wall, guys, here actually. See that 1997, even here. There's probably going to be some resistance right here. So when gold is worth about 2/3 of SPX, that's probably going to be the time we'll be stretched from moving averages, you know, it's going to be just crazy there. So, but look, it's still dragging downwards, you know. Still
in there.
Still having, it hasn't broken out of a horizontal breakout line by any means yet, but this is very, very constructive right here. Even this line here. Sometimes I drew this one where I actually had a breakout and I was just having a retest of it, but I have to lower the line. And like I said at the beginning, the less and less, the more and more steep that line is, the more I lower it, the more it is susceptible for like you know, you throw a rock, but then it just goes up a certain height, then it tumbles lower. And that's kind of what happened here. That line was too steep, try to move up, hit resistance, and then it just back tested it. But as time moves on, this line, I'll keep that one on here. But as time moves on, we're just going to be overcoming less and less steep lines until that there's no more downwards momentum, right? But the sweet spot is probably around here. People don't need to wait until, look, by the time gold's worth 2/3 of SPX, it's too, like, there's a limit. You can't wait until you're 90% confirmed that everything's like golden dust, right? That's perfect. This is probably going to be the sweet spot there. It's approaching. And I'll give you another clue. Let me do a spin off to gold versus energy, because energy has been, that thing has been oil stuff you could actually play. You could buy, look at that. Oh my goodness. I put Brent futures, guys, because there's less of a spike. Whatever happened in March Madness in 2020, you know, that negative oil, it just have these crazy wicks. But if you use Brent oil, they didn't register like that crazy spike in the negative as Texas light sweet crude oil. Am I saying that? It's so, there's so many prefixes.
Crude, yes.
Texas, it's light sweet crude Texas oil.
Yeah, West Texas Intermediate Crude, WTIC.
So look at this thing, blow off top for the ages. For the ages, look at this thing. This is like a 2000 type of bubble in favor of SPX versus oil, that blow off top of the ages, breaks down, retest that 3 moving average. Look at that thing, man. That's just, it's falling apart right now. Here, let's draw some trend lines.
If you back way out, like big picture view, I saw you had a bunch of data. So that's a huge, like double top end of trend type thing going on.
Oh, yes. Yeah, here. Look at that.
Yeah.
So,
jeez.
Yeah. So what do we do with that, guys? So here's probably the next spot where it's going to halt. And it actually halted a few times here. So what was previous resistance? So here, the 1968, 1972 blow off top for SPX versus oil. Here, it did a a top. Then here, the US equities. And this is how crazy it is. Think about it this way. 1968 to 1996. How many years is that? Help me, Andy. 30 years? It took 30 years.
Yeah.
30 years for US equities to break out versus oil. Because all this time, yes, broke out to at least overcome its previous all-time highs. And that was a blow-off top. Breakdown, resistance. It's lots of touch points here. Support, support, support. And yeah, is that a head and shoulders top?
Sure, looks like it.
Yeah, I'm not I know people are finicky about their definitions of head and shoulders top. My key takeaway for a head and shoulders top is not the left shoulder and the head. I don't really care about that. All I know is I have a high and I have a lower high, because essentially that's what's bearish about the head and shoulders pattern. It's a high and a lower high. I know people like looking at that, but I don't really, maybe they put the left shoulder here because they want to say that, look, you had a blow off top, which was usually the head, but this is not looking good here. And if I do hollow candles,
it's looking good for oil investors, not
goodness.
for the S&P.
Yeah, we'll show your viewers there
Yeah.
what I see for actual gas and oil producers. And look at this thing here. That's a breakdown.
Totally.
That's a breakdown, rising wedge or rising channel right below a moving average or at a moving average. I could probably fine tune that moving average to the 4-year, but at a wall. So here, blow off top, echo bubble, support, 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 breaks down. Now this breakdown confirms that support has been flipped into resistance. Headwinds, tailwinds become headwinds. And look at that, to the T, it hit there. And now it's just going down, and it tried to do a rally, but now since the beginning of the month, you see that wick? That wick, guys, is actually sellers coming in. So the target of this rising wedge is, in all likelihood, right now, it's a high probability that we're going to go test this. We're going to go test this line once again. So 1, 2, 3, that's a valid breakdown line. If that breaks down, gold is probably going to be breaking out versus SPX, right? On the chart we saw, SPX is probably going to be breaking down versus PPI, because that's a big part of the PPI is that oil chart. And then we get a measure move.
It's huge. It's huge.
Well, it's this. It's back to 2011 highs. That's what's on the table, guys. So this is baby move, and this is big bear move. That essentially that's the roadmap I've been seeing for a very long time. Yeah. The rallies are always higher than I think, but it is what it is. You have to adapt, and as the chart morphs, you can't. That's the edge we have as a TA guy. We could have a narrative in our head of why the SPX should do badly versus energy, but the chart's telling you when it's actually happening and if it's still happening. But right now, this is very bullish in favor of oil. Look at this, guys. Let's give some oh yeah, that was my mystery chart on Twitter.
Yeah,
I think only one guy guessed it. So here I'll remove drawings. Look at this thing, guys. This is just bonkers. This quarterly candle close above a beautiful bull flag. So all these months here, these wicks and the sellers coming in before the end of the quarter, 1 time, 2 times, 3 times, 4 times, 5 can get. It took 6 quarters for oil and gas explorers and producers to break out. That's a confirmed breakout out of a pull flag. So that's what it is, guys. It's crazy like that, man. It's broken out. It did a retest during the month. That's the wick. And now it's just onwards and upwards there for oil and gas plays. I was just like, I saw that. Then I went back on the daily, on the monthly. For me, the month and on the monthly, because it's kind of, you can't see. Okay, this is another thing. The higher the time frame, the lower the breakout line is. I've noticed, because it removes a lot of the noise. The higher the time frame, it leaves the wicks, right? But then after that, that means you don't go knock out a new higher watermark where that becomes your trend line. The higher the time frame, the lower the breakout line is. And look at that. You can't really see it. This is my quarterly defined breakout line. We've closed above it. You know what I'm going to do? Just to highlight you when that happened. I'm going to put here. That was July. So that's a quarter that end in July. So that's actually August 30th or September 1st, right? That's September 1st. No, September 30th, right? That's when the quarter closed. October, November. Yeah, September 30th. I'll put it back on the monthly. So you see, this is the July. So July, August, September. So we had the quarterly close right here on this candle right here. That's when we had the confirmed quarterly close, but we did not have a horizontal confirmed monthly close breakout. We still don't have it, but you did have an early bird, what I call an early bird breakout, a wake up line. Is it's steep. Remember, we covered how when it's steep, it's less valuable than when it's horizontal. But that higher time frames breakout gave you a clue that there was a good likelihood that you should have probably entered, or that this monthly defined early bird breakout, is a more steep angled line, was actually going to be the real deal. And by the all looks of it, I think this line's going to break there. So there's a high, for me, it hasn't broken out yet on the monthly chart, but because it did break out on the quarterly, and the measured move is higher than that level here, 154, there's a good chance that we bust through this breakout. And where's the target? Well, the target here
What about
below,
an inverted head and shoulders there, potentially?
here and here, right?
Yeah,
That's crazy.
a
There's
massive one with
yes.
a slight angled,
Yeah, like it's
slightly angled. Yep.
yeah, there's a huge wall. Like, I'll remove all the drawings. There's a huge
Yeah,
wall
huge
right
wall
here.
over at.
Yeah, it's where I put my alert. So this line is where it's my area of interest.
Yep.
So yeah, practically here, it's a zone. So here's the measured move. Here's how far it was able to stretch from the 3-year moving average the previous time. And was able to stretch 87% away from its moving average.
Mm-hmm.
And if I do a price 87%, here's my 3-year moving average right here. I'll just do an extension of the red line, which is my 3-year moving average, to extrapolate. I'll remove the 1 year. So let's say the price stays above, and there's always data points above, then the moving average should continue at pretty much on this trajectory. And here is my distance. I'm 87% above my 3-year moving average, because I know that's when it did a needed consolidation last time. And then all I have to do is stretch that. And depending when we break out in time, I know I have enough steam in the tank to pretty much go test the previous highs there. So this thing is destined to do a reverse symmetry move back to, where's my arrow? This is probably, this is the higher likelihood roadmap right now, is we're going back here, guys. Probably somewhere here. So this thing is going from, I don't know, 153 to 272. As these layers of resistance get stripped and convert that headwind into tailwinds, that's a roadmap. And I could have also done some classical TA on that. Measured move, pull flag. Often the pull flag, I don't get greedy. A lot of people do this. It's fine, but that creates a target like 5, 6, 7 years in the future. That could be too long, and a lot of stuff could happen. If you take from the most recent swing low, it could either be this one or this one here, the swing low, and you add that on the breakout line. You look at that, it just matches to perfection our target area. So you got energy going into a consolidation pattern, correction, explosion out, and this is non-greedy stored energy added on top. I know I'm able to distance myself from the moving average. And a lot of people are going to probably start entering here at 280, right? People are going to see that big pattern, but it's probably going to need some consolidation by the time it gets to 280. It's probably going to do maybe a year and a half consolidation. It's going to do something here to trap everybody, consolidate either in time or price. Like, I don't know, if it's a market crash, it might go down violent. Might even, who knows, man? Maybe it's going to go and retest this from above. Like, why not? But if you enter early on the breakouts, the low risk entry points, and you don't buy when it's stretched from moving averages, it's easy to sell because you've made your money. You're there, you're hitting resistance. Hey, I'm out. I'll let other people get in. So that's the roadmap for oil and gas, which is super, super, super bullish. I could spin off to just to show you this one versus XOP versus NVIDIA, or NVIDIA versus XOP. Move drawings, remove indicators. And just like clockwork, look at that NVIDIA where it halted versus XOP. Just here on this breakout line here. So the low risk entry for NVIDIA was back here. So here it broke down versus XOP, 1 touch, 2 touch, 3 touch. Oh, consolidation flag. Okay, I'm off to the races. That was a time to go really long NVIDIA instead of oil, gas, and all that stuff. Now we're going sideways there. How long is this going to go sideways? Are we going to go? Where's my squiggly? I did this. Is it just going to be here and then here? Is it going to be here, here? What are we dealing with here? We don't quite know where this is going to settle, but let's not think doom and gloom. It's not about NVIDIA going to hit the bottom of this wedge versus XOP. If NVIDIA is not able to break out and continue its uptrend versus XOP, you should say, why am I long NVIDIA? I should be looking at XOP. And you could even do better, because in XOP, there'll be outperformers. There'll be better oil companies. So now you could do an oil company divided by XOP. You'll see which one's outperforming. You'll see which one's paying dividends. Crazy dividends. Crazy. I've never seen stuff like that. 10%, 8%, 20%. It's like people there.
Huge difference.
And
Love
the
it.
price and share price appreciation. Double whammy. It's like, you know, it's such a no-brainer. And this is very bullish. That means as long as NVIDIA muddles sideways like this versus versus energy stocks, that was a bull era here from 2007 to 2011, 12. Gold, silver did great, right? Until this thing bottomed and then broke out.
Yeah.
So that's a big picture. NVIDIA, I took probably the strongest of all the US equity stocks, and I'm pitting it against the oil and gas barons, and the oil and gas barons are holding their own right now there. They have for essentially for 3 years, since 2020. Since 2020.
That's when interest rates started going up. Interest rates go up. Growth stocks hate that. Absolutely hate it.
Look at that. That was the death knell. Look at that. Well, this is the Fed fund rate. If I put the 10-year
2-year yield.
Yeah, the
or somewhere
2-year
10-year. Yeah, 10-year to work. TNX.
Oh, whoops. TNX. Because you got to remember, in the 70s, the Fed fund rate, they lowered it. Like, they went up and they lowered the Fed fund rate. Like, they cut massively in the early 70s. But the 10-year yields did not do a new low. So while the Fed fund rates did a new low in the 70s, or I forget, I think it did a marginally low, but the 10-year yields, the market refused to do a new low. It did a higher low. So I always like looking at, here's the 10-year yield. Look at that, 10-year yields start going up. Forget the Fed fund rate. 10-year yields in the 2020, that's exactly when they started turning upwards.
Yeah, the 10-year yield, as it goes up, growth stocks hate that.
That's right.
Absolutely. But oil stocks love it. They go berserk.
They go berserk, especially if you could combine the DXY divided by PPI or CPI, or by the yields, CPI-AU. So here's the DXY divided by. So it's a combination of. So this is massive. This is a DXY adjusted for inflation. This is more a driver for gold and silver. So let's see what happens here. If that thing falls down, I'm expecting a huge leg in gold and silver, right? Even here, well, I think it did impact oil, because you see oil, it kind of peaked in 2007. It refused. I'll put oil chart here. US oil, new price scale. And I'll put on log and I'll flip it. Yeah, I see the oil chart tracks that exactly. So yeah, oil wants this to break down there. If DXY adjusted for inflation breaks down, there's a high likelihood that oil keeps going bonkers. Whew.
It will. It will.
That's pretty much the big picture. That very what I looked at. Ooh, gold, silver. Yeah, they're giving up gains today. So you gotta U.S. equities are. So even if I see a positive day in the Russell 2-3% like we did yesterday,
Yep.
people have to zoom out because you might get 2 beautiful green days and then a series of 5-6 red days. But you can only see if you look too closely, you see green, red, green, red, green, red, 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 red. If you don't zoom out, you can't see the cumulative effects of all these green and red days. And that's on those charts there that we showed everybody where price in oil, the SPX is rolling over. It's like people have to zoom out. And it's just bonkers. Look at that. Nvidia's down 3% today. I don't like doing that. I do it because I'm there. Oh, it's down 3%. But even myself, sometimes I get trapped in that daily stuff. I look at it, but then I said, Patrick, it didn't change anything in the big picture. It's like you have to let these things, play out, position yourself correctly, and then just ride that beautiful multi-year trend. Zero hassle, collect a few years of dividends, 4, 5, 6 years. I don't know. Like, who knows how long that's going to last? Or Kevin asked me this morning, how long do you think this oil bull era is going to continue? Look, as long as it's trending upwards above its 1 year or 3-year moving average, sure, we could time entries, by trading it and exiting it. And while it's consolidating a year, just step aside, play something else. But it's like, there's no end in sight right now. There's no bear market. It's like, it's not rolling over by any means right now. And it's just going to get fueled once that SPX to PPI chart really starts rolling over. That's when we're going to see the fireworks.
I think it's all inflation related. It's my guess. So if you watch interest rates and inflation, yeah, oil is the most sensitive inflation asset.
Yes.
Money's just going to rotate right into it. It'll just go right over there.
So the chicken and the egg. So the oil is a symptom or the cause of inflation?
It would be the symptom of credit growth, but it's what's seen in the consumer price index.
Exactly.
That's my take on it.
Yes, because they can't print oil, but they can print fiat.
Yep, they print the fiat, then or credit expands in the system,
Yes.
then it goes into oil, and then it goes and is seen in the CPI. That's the way that I view it.
Well, that's reasonable. And this is another lesson for everybody. When they're looking at, there's a Bitcoin ETF coming, they're looking at all these micro headline news that they think that's driving the price, but you're right, it's all instigated by the major asset classes duking it out. If the rate of change of the money supply or the credit growth, the rate of change, if that's breaking out, the rate of change of it's always increasing practically over years, but what fluctuates these cycles between energy and growth is when the rate of change it breaks out, when you enter like a sprint phase. That's what's driving practically everything. Sometimes I like doing the exercise on Twitter, and I could put a chart of anything, and you think your chart's so special, but then I show you another chart of another company of something else that looks exactly the same. I said, look, something else is guiding those capital flows. It's not the CEO of that company. It's just like you said there. It's the money has. It's not JP Morgan. It's not the comics. It's not William Banks. The money has to go into energy. It has to go in oil because that's the only way these people could hedge their bets, or where that's just where it goes, guys. It has to go there. There's no no manipulation required.
When inflation kicks up, bondholders do not like it, so they sell all their bonds, and then you'll see the interest rates go up and chase the inflation.
Yes, yeah,
and then the money's like, yeah, it doesn't know where to go.
And it plays out it needs the time that it needs to play out, 6, 7, 8 years. And then they think it's Paul Volcker that fixed everything. No, the cycle was ending. He just happened to be there. He actually raised rates he actually lowered rates more than he raised them, Paul Volcker. It was the other guys before that raised the rates during the cycle, Arthur Burns and all these guys. These guys raised all the rates. He came at the end and he actually raised them maybe once or twice in 1980, and then after that he just kept cutting them more than everybody, like more than raised them. So it's not him that killed inflation. It's just the cycle was ending.
I totally agree with that. Totally agree with that statement. Cycle is just ending. And nothing to do with him. So what's that?
And now we're starting we're about to start a new one there.
Yep, we're in a new cycle. And now Powell's the one that's got to deal with it.
Yeah. And who knows if he's going to be the sitting chairman when it's all over. Probably not. There'll be somebody, the guy, and that other guy is going to take all the credit. You know? He's gonna say, hey, I stopped it.
Yeah, agreed. So I mean, that's all I've got. You got anything else to comment on, Patrick?
Short and sweet. Hopefully this helps everybody, all your viewers, and understand the charts better and what we're seeing. It's all good.
And if somebody wants to follow you, reach out.
Yeah, Bad Charts One, guys, because if it'd be just Bad Charts, this other guy took it before me. Bad Charts One back in 2012. The guy doesn't even do charts. But anyways, doesn't matter. Bad Charts One's on Twitter or my website, northstarbadcharts.com.
Great, Patrick. Thanks for coming on. Really appreciate it.
Time to wear your winter gear, guys. Your winter gear.
Yes, it's coming. All right, guys. See ya.
Bye, man.